Guys, just under 2 minutes and we're starting. We got Trader Nick joining us today. The legend. Guys, get your questions ready. 50K Maven Challenge for the best question that is relevant to Nick's trading experience. Guys, awesome. Welcome. Trader Nick, really awesome for him to be here. We've gone way back, quite a few years now, actually, back to the days where, I called you a funny or a goofy guy or something like that. And we panned things out eventually. Cool. One of the influencers in the space that I really honestly respect. He has a very slow-paced approach to winning in the trading market, more of a long-term positional-based trading style, and leveraging his risk management in a way that allows him to win in the long run without doing these crazy day trading, swing scalping sort of things. Nick, give yourself a little bit of an introduction for anyone who may not know you. I'm sure everyone knows you though.
Hunter, yeah, it's good to be talking to you again. Probably, I don't even know how many times we've collabed and done things together, so it's good to be chatting with you again. I know James is in and out currently, but I've also spoken several times with James as well, so it's good to see both of you guys. And to your audience, hello, thank you for having me on. This is cool. Yeah, I've been trading for almost 10 years, I guess. A little under that, like 9 years or so. Yeah. I got into trading because I had really my dad was interested in financial markets for a long time. I always saw him looking at stock charts for the longest time. And eventually I started taking an interest in it and started playing around with it myself. And, that's really where my interest eventually started, initially in stocks. And then eventually I started exploring the world of Forex. And I have a background in software engineering. So a lot of what I've done with my trading world has been software centric. So I've been, a programmer by trade, and took that with me into my trading. Like I started building systems and indicators and back testing and writing code for stuff. That's really how I kind of tried to figure out how to trade and invest, is through software and through programming, which, I think was actually a really good place to start. Because a lot of times, people just sort of pull a YouTube video open and they just trust it because some guy who has a big following is like, hey, this strategy works. Whereas in my world, it was like I wanted to test everything and try everything, which I think served me really well.
Awesome. That's going to give the audience a little bit of open doors to, we can probably talk a little about the tech side. James, can you hear us all right now?
I can. What's up, Nick?
Perfect.
Hey, James. Good to see you, man.
Yeah, it's been a while.
Yeah, cool. So tell us about, I know you have a piece of software that you sell that is, what is it called? A1?
The Edge Finder.
The Edge Finder, yeah. What does that do exactly?
Yeah, so a lot of where I've gone in my trading, I tried many different directions in the early days, and what I found, and there's nothing against being a very technical analysis focused trader, but I am not that. I'm much more of a macro trader, and macro being, the stuff that really moves the markets. At the end of the day, not no shade to people who are purely technical, but the stuff that really moves the markets is not head and shoulders patterns and support and resistance levels and moving averages, or God forbid you get into like the fair value gaps and all that stuff. Like you can go down that rabbit hole if you want, but I started, thinking about it logically one day, and two things really struck me real hard. First of all, I was like, okay, what moves the markets? Those red candle news events or red folder news events.
Scary
I was
stuff.
like, why does everybody care about that so much? Why is that the thing that moves the markets? And when you start to actually do your homework and do your research on what red folder news events actually mean for the economies of the world, what they mean for financial markets, you start to recognize why they move the market so much. Big players are looking at those events because they give, in my view, one of the most uh, approachable ways to actually get a forward look at the markets. Everybody always talks about how indicators are lagging, price action is lagging, right? You're looking to the left, you're looking historically at what's been going on to try and make a prediction of the future, which is to some extent always true about everything. You're always looking at what's happening in the past to try and make a prediction of the future. But fundamental analysis or macro, looking at the trajectory of jobs market data, trajectory of inflation and prices around the world, like commodity prices, like how much you're paying at the gas pump. These are real things that we can see. They're trends happening in our real world that impacts the charts that we trade. So I started like diving deeper into that. And then I started thinking about it and I was like, well, there's a dime a dozen charlatans all over social media that talk about technical analysis being this holy grail magic money printing machine. But none of them can like really show you track records. And then I started looking at, well, who in the industry has track records? You know who does? The people who have track records. There's a few influencers. I've done my best, and I know a couple, hand selected really great influencers that have, been transparent and honest and shared track records. But who objectively has the strongest one? Money managers. Why? Because money managers have to report to the people's money that they're managing, right? So, and when you listen to, I challenge your audience, if you don't think fundamentals matter or they don't have some real serious power to them, turn on CNBC, Bloomberg, Fox, again, whatever, take your pick of some business television where they're talking about the stock market, where they're talking about financial markets, and listen to what these interviewees are saying. And you ask yourself, are they talking about head and shoulders patterns and support and resistance? Or are they talking about the Fed, inflation, business cycles, financials of companies? And you will find that they are heavily talking about that. So if pros that have audited track records who do really well in the markets to make millions and billions of dollars are talking about that, I started to reverse everything I thought about trading. And I realized that is what pros talk about. They focus on the economy. And so it's a huge study. There's a huge learning curve. And I think that's why most traders are scared off by it. But I took the approach to say, okay, long story short, I see the value in understanding that stuff. I can see how it's causing huge trends, like the dollar in 2022, where it just went straight up for like a year and a half because the Fed was hiking rates. Once you understand those trends are in action, you can take advantage of riding them. It's a huge, it's a superpower in trading to understand why markets are moving and whether they're likely to continue trending in that direction. Not just because candlesticks are moving that way, but because there's a real reason behind the prices moving. So that's kind of the long story short as to why I went the direction I went years ago with becoming more of a macro-centric trader. And I saw a huge need in the space. I just listed all these like hypothetical grand economic data stuff, but how do you actually track it? And so I went on this journey. I combined my software engineering path with my love for financial markets and studying the economy. And I built a collection of tools that help us to scan and track that. And at this point, we have several thousands of people all over the world using our tools to track macro data. And I think it fills a need that is really needed in the retail trading space.
Yeah, that's unreal, man. Well, we're going to talk about, because I really want to know like the most important things for the traders to take away. We'll talk about that more later, that they can actively track and put into work for themselves. We'll talk about that in a moment. But I just wanted to note, like a lot of traders, we get common questions in here that say, what's the best type of trader, right? Like what type of trader gets the most payouts from prop firms? And time again, I do a lot of interviews with traders. It's the guys who track the fundamentals and then use some sort of key level, right? And keep it super simple, keep it dumb and boring, right? And then they're following those trends from, the Fed or NFP or whatever it is, right?
I saw your post about that, and I it's so facts. Just because it's not only the macro traders. It's not necessarily just because they use macro. It's also because macro traders tend to not be so short term. And when you get really short term, again, for the listeners, I'm not trying to gatekeep or say you can't do it a certain way, but for really low time frame traders, I do think you are taking on an added level of difficulty trying to scalp and day trade. So again, swing traders tend to be macro, or I'm sorry, macro traders tend to be swing and position traders. Swing and position traders tend to do better just because there's lower trading costs, there's less noise, etc.
Totally. And exactly the less noise, because when you're on the 1 minute time frame, you have to worry about everything above it as well.
Right.
Hey, James, I'm going to get you to help me with some of the questions today too.
Yeah.
Because I think a lot of these guys, I think there's going to be a lot of good questions here. I see one here, more or less along these lines. What would be your preferred trading style if you only used technicals?
If I only use technical analysis, what I would do, seasonality is a tool that I use. That's my favorite technical tool, is to study historical tendencies. They've kind of gone out the window this month, but typically the S&P 500 is down in the month of September. In the last 10 years, I think it's averaged a minus 0.7% gain.
Oh, wow.
So, things like that, I really like studies. I like data. I like things of that nature.
Yeah.
And having the tools to do that is critical for me. So I think if I was to be purely technical, it would probably be the daily chart, the 4-hour chart, and the weekly. That combination is what I personally use. I like to trail stops, which one of the reasons that I really like trailing stops, there's pros and cons to every style of trading, right? If you take profits quickly, you sometimes miss the big runner. If you try and go for a trailing stop, sometimes you give up all your gains because the market reverses. Like, there's nothing perfect. There's no holy grail. But I like trailing stops because when you are really correct, and this does sort of lend towards the fundamental side, because sometimes you catch a really big fundamental trend that just goes and goes and goes. I mean, look at gold right now. You have every reason for gold to be skyrocketing fundamentally, and it really supports the move. In fact, super contrary to popular belief, but the last 3 weeks I've been saying I think gold is still cheap, and I still think it's cheap today. Yeah, sure, it's gone up a ton, but price going up a ton doesn't tell you value. That just tells you price. There is a difference in that combination. So for me, technicals wise, I prefer the daily chart, the 4-hour chart. I prefer to use simple market structure. I know you're a big advocate for that too, Hunter. This concept of like, keep it so dumb. Like, literally you talk about dumb money concepts. For me, technical analysis, you could literally go to a book off the shelf, whip it open, go to the first technical analysis, age-old 1920s support and resistance video,
What about trend lines?
yeah, and that's all I need. Like, I don't really need to get any more complex than that. I truly think simple is better.
Yeah.
But if I'm being fully, transparent about my approach, technicals are probably 15 to 20% of my process. Like, most of it is macro, and I think far more important than entries is managing your exits, like letting a trade run, becoming a bigger winner. My style, right? I also, if you're more of a quick take profit kind of person, it just matters your expectancy and measuring whatever you're doing. And I think most traders are just not doing that. Most traders like to believe they have an edge when they probably do not. Most traders, like the idea of only being technical because fundamentals are scary and difficult to learn. But nothing about trading is easy, right? Like, if you spend any amount of time, you start realizing, okay, trading is hard as anything. And so when I sort of added, and I'm also not someone who thinks like, if you do not use fundamentals, you cannot be profitable. I'm not like a supremacist by any means when it comes to this stuff. I just think for me, it's like it adds a clarity to the markets that really help me to understand why things are moving. And I have a knack for it. Like, I just think it works well in my brain. It's a storytelling thing. Fundamentals are like trying to pick up the story of why markets are moving. And so I do lend towards that. But if I were only technical, higher time frames, trailing stops, market structure.
Just based on that, quick one, Nick, I was actually just looking at that seasonality. You're right. September in the last 5 years is the worst month for the S&P 500. And the best month is actually November in the last 5 years.
Wow.
So, yeah.
Yes.
I suspect probably because of Black Friday.
Yeah. Average monthly return in the last 5 years in September is negative 4.01% on the ES chart. And then for November, it's actually positive 6.01%.
Yeah, and let me see if I can share my screen really quick. I'll just see if I can show you.
I've got it up here. I can share it too. But yeah, it's pretty interesting.
Let's go entire screen. Go here on the left. Boom, bam. Okay. Yeah, so what we're looking at here is just like our tool. I know there's lots of different seasonality tools. We have many different screens that we'll do. But like if I'm looking at just seasonality, I've got the S&P 500 selected here. We can select it for whatever. It's about a minus 0.7% reading in the last 10-year average. This year has completely broken that trend, right? We're up, you know, significantly in this month. And then that concept about November being a really good month. One thing to think about that, a lot of times this end of year rally, it's a little bit of a self-fulfilling prophecy because we've had such a roaring bull market for the last 10 years. There's this chase for performance that tends to happen among hedge funds and money managers who are like, look, I've missed a bunch of the rally. I've got clients to answer to at the end of the year that want to know, like, hey, are we in NVIDIA? Are we long, you know, the NASDAQ? Like, are they, you know, at the golf club, you know, they want to be able to say like, hey, yeah, we're in NVIDIA. Don't worry. You know, we've caught the move.
You're going golfing over the Christmas break is what you're saying. Hey.
Yeah. Typically there is the Santa Claus. Well, yeah. Or the Christmas party, right? Like whatever it is, you know? So it's one of those things. I think, it's a weird concept. There's also historically less buybacks from companies who buy back their own shares during the month of September. There's also like some tax loss harvesting that can go on, or tax strategy stuff. There's just all sorts of things that, regardless of the reasoning, right? You can make up your reasoning. At the end of the day, it historically tends to do this. So I do use that as a part of my trading. But what the tool that I've built, the reason I'm you know, so adamant about what I've built is when it comes to this stuff, it's great to be able to point out that and look at that. But that's one indicator. Seasonality is one thing. There's many things to look at. There's GDP growth. There's what the commitment of traders data is showing us. Are institutions buying gold? Are they selling gold? So what our dashboard here looks at is a collection of indicators, right? So, and none of these are, only one of them is technical, right? Trend. Seasonality is the other one, I guess. So there's two. Then there's also the commitment of traders report, retail positioning, and then we have a bunch of economic data. So GDP statistics, manufacturing and services PMIs, retail sales numbers, which gives us an insight on consumer spending. Inflation, several inflation readings, actually, the CPI, PPI, and PCE, employment change, unemployment rate, and interest rates. So we're looking really at all of these things, and these things are too many things to put in your head and just remember. So we've built an algorithm that looks at all of it and generates bullish and bearish readings for your favorite charts. I think that's why people have gravitated to the tool. Is you can also, of course, look into something like if we want to talk about inflation in the United States, you can see inflation in the US has actually been on the rise. You know, you have inflation going up and jobs data going down. That's a good, you know, environment for why gold is going up so much. Right. So it's like a little bit of an uncertainty thing. If you have rising inflation, and then if we take a look at unemployment rate also on the rise here in the US, that combination is a real force. That's a rising risk of what they call stagflation, which is slowing in the economy and rise in inflation. That combination is very bullish for gold because people panic and they go into something that they feel a little bit more safe in. So this is understanding the real story behind why prices are doing what they're doing and not just looking at the price action. Again,
how does that explain then the stock market doing so incredibly well. If gold is doing very well, you're getting this potential stagflation. Usually people pull out of risky assets and put into safer assets.
Yep.
Well, everything's been booming lately.
Yes, you're correct. And if I pull up, let's just look at the US, because I assume you're talking about like US stock market has just been fire. So US stocks are kind of interesting because, of course, it goes beyond just what's happening in the economy. There's also a lot of sentiment stuff that happens in stock markets. There's also, corporate earnings are a big force in financial markets. In fact, there's this weird anomaly happening right now where the lower end consumer and the jobs market are kind of lackluster, yet you have the stock market hitting all-time highs. And that's confusing.
The thing that's confusing me, what you're saying is that if the economy is slowing down, then shouldn't the performance of the companies also be slowing down? And then the reports, the quarterly reports should be underperforming.
Yeah, no, that's a great point. And I actually think that there is a possibility that you do start to see that materialize. Like I do actually think that sometimes fundamentals and technicals can diverge, right? So in my opinion, I do actually see a little bit of risk to stocks at all-time highs. I personally don't really see them as a huge buy at these levels. I think there's potential pullbacks. But to your point, if we're looking at the economy, if you isolated the jobs market, which is going to be, here's a couple statistics about the jobs market specifically. Non-farm payrolls have been consistently missing expectations recently. We expected last month's to be 75,000 jobs added. We only got 22,000. It's a huge miss. ADP, which is the private payroll sector, also came in much lighter than expected at 54,000. And job openings have been in decline for multiple years. Historically, Hunter, you're actually dead on. Like historically, when the jobs market is hurting, the stock market starts to hurt. The weird anomaly that we're going through is this phenomenon around AI, where you're seeing, AI sort of efficiency helping to boost corporate earnings despite the jobs data weakening. However, I do think that the weakening jobs data will still ultimately cost on, if we continue to see that hurt the consumer and consumer spending starts to weaken, that will impact corporate earnings and cause markets to fall. The only thing is we still see the earnings report. Like if we take a look at retail sales, consumer spending is still beating expectations recently. We also have above expected growth in GDP, 3.3% quarter over quarter growth is above trend and above forecasts of 3%. So this is what we're doing. We're looking at the data, right? So we can all have our ideas of what the economy is like, but looking at the data tells us what the economy is like.
There's another kind of outlier going on right now too, is the rates being cut while being at all-time highs. And if I'm not mistaken, that's an incredibly rare thing where now the rich are going to get richer sort of thing, because the people who maybe aren't necessarily already have money in the stock market aren't buying the very top, right?
No, that's a really good point.
The more inflation going up, the more money being printed, right? It's going to cause the stock market to go up, but then the people who aren't having, the job market's going down, they don't have the jobs, they don't have the income to invest, right? It's going to make an even bigger divergence between the rich and the poor.
Yeah. And that's a serious, concerning thing, is the idea that why is the Fed cutting rates? Well, they're not doing it for no reason. The jobs data looks pretty rough out there. Powell called it a risk management cut, where he cut interest rates by a quarter point, sort of as a bit of a hedge to what's going on in the labor market. If the labor market continues to move south while inflation does not move south, I do think that there is potential for the markets to have some sort of pullback. We've been on a straight shot to the upside. I think the Nasdaq's up like 50% from the lows. And that doesn't go on forever. So I'm not short. I don't think that, there's a huge conviction to short the market at these levels, but I do see the risks to it. And I'd rather wait for pullbacks if I was going to buy something.
Totally. That's exactly how I feel for longer term swings as well.
Yeah.
Nick, so you said, I know I follow you obviously on socials, and we've had you on our podcast as well with Austin. What in terms of swing trading, what markets are you predominantly trading? Like, let's say the last 2 years. What I know you love trading the Nasdaq, and I think that's probably your favorite one. But what markets do you love trading personally?
Yeah, the Nasdaq is my favorite. But honestly, it changes. And again, the cool thing about having a system, right? Making it systematic. And I know this sounds like one big sales pitch, and it kind of is. It's a great tool and everyone should buy it. But, obviously, I do actually genuinely use this to help me spot trades, and it changes what's kind of on my radar. Sometimes it's more currencies, sometimes it's more commodities, sometimes it's more indices. Like right now, I don't have a bunch of interest in going long the indices or commodities because they're kind of at highs, and my system is sort of picking up that there's mixed sentiment. I mean, Hunter's concerns about like the economy and the jobs market, that's totally valid, and the system is sort of picking that up as well. So that's the theory around having a system to help me find opportunities. But yeah, I would say most of my trading involves the indices, gold, silver, oil, mostly indices and commodities. I also trade individual stocks.
Oh, yeah, that's what I'm gonna ask. Individual stocks as well, but you still trading obviously them as CFDs, correct? Not as futures contracts.
I actually trade ETFs the most. In
Okay.
the US, I know that's for people outside the US, not as accessible, but for ETFs, they just have very low holding fees. And so for me, if I'm gonna like buy something and swing trade it, it might mean I'm in the trade for a month and a half. Like that is going to be something where I'm just have a much lower cost to hold it.
Yeah, because I know you used to trade quite a lot with Owanda, correct? The broker Owanda. Obviously, that's one of the
I still do.
only few CFD brokers in America that are regulated.
Yeah, and so I do still trade with Owanda, and the thing is with them, they in terms of their CFD platform, it's not available to US traders. Like US traders, we can't trade any CFDs legally, at least through like a regulated like brokerage.
Exchange.
But yeah, so I'll still use like Owanda for my FX trading, but then for the rest of what I do, it's on a stock and options brokerage.
Got it. Nice.
So I got a question from Pranav, asking about, since you talk about the red folder newses, can you give us a breakdown of how someone can interpret them?
Yes. So again, to just use the explanations that are right here. So if I was looking at a couple red folder news that everyone knows, CPI, NFP, FOMC, right? Yeah. These acronyms that sometimes people don't even know what they actually mean, right? Consumer price index and gross domestic product, like these things mean something. So I would encourage you, if like you see a red folder news, the next time you see a red folder news, do some research. What is this? Even if you don't necessarily trade based off of it, just understand what it is. Why are people gathered for CPI? It's a consumer price index. It's giving us a year-over-year reading on a basket of prices in the economy, right? And that's a really telling thing about price movements and how that could impact the consumer and businesses, et cetera. So that's the first thing I would say is just look these things up. What do they mean? What do they stand for? What do they tell us? And do a little bit of research on each one. Then, we've built some stuff to understand the impact on currency for the underlying economy and the underlying equities market for that economy. So, for example, if GDP growth in the United States comes in better than forecasts, so in this example, forecast for GDP was 3% quarter over quarter growth, we actually got 3.3%. That's a beat. That's better than expected. Strong growth for the economy. And so how does that impact the US dollar? You can ask yourself kind of intuitively, if the economy is growing in the US, is that better or worse for the underlying currency? It's better, right? Stronger. Hey, that currency has a strong underlying economy. Is it better or worse for stocks in that economy? It's better. Why? Because that means companies are going to grow more. There's more spending going on. There's more activity going on. And we can go line by line with this software, and it's tracking and monitoring and building a bias based on all of these data points as they come in. The whole point of our tool, the reason it's so popular is because it does all of that research for you. That's a lot of stuff to try and keep in your head. Yeah. So we built software to track it. So we can go through all of them. Let's do CPI. CPI is a little bit, let's do PPI because it has a more interesting reading currently. So if we're looking at the producer price index year over year, what we see is that we had a reading of 2.6%. This reading came in lower than forecast. Forecast was for 3.3% year over year. Producer price index, that's going to be wholesale. That's further up the supply chain, right? These are big businesses before it gets to the consumer and goes into your pantry where you buy your snacks, right? This is high up the chain. Producer prices rose by 2.6%. They were expected to rise by 3.3%. Is that good or bad for the economy and for the currency and for the stock market? Well, for the currency, it's actually bearish. Why? Lower inflation gives the Fed the ability to cut interest rates, lower borrowing rates, and that weakens the existing supply of currency because it essentially prints more into existence.
Yeah.
At the same time, is that good or bad for stocks? It's great for stocks because lower inflation essentially means lower interest rates. Lower interest rates means people can go borrow money, and it's stimulus to the economy, which ultimately lands in the pockets of corporations. So we're just automating this whole process. Everything I'm explaining is automated through our tools, and that's the idea.
Awesome. That's a really awesome explanation, actually. And so to further that, this is what I wanted to touch on, and I left a little bit of a cliffhanger early on. What are kind of the key things, if you could pick just 2 or 3 key things fundamentally that somebody could look at so they could better analyze the trend of gold and the stock market or Forex, right? You can pick and choose which ones here. What would they be looking at?
So the biggest ones, the biggest, most important metrics are going to be, let's do 3. So if I was to only choose 2, I'll do 2 in a second, but 3 would be growth. How do you track growth? What's the easiest way to track growth? GDP stats, right? So GDP, you do also have manufacturing PMIs and services PMIs and retail sales. Those are also metrics of growth as well. But let's just go for the big one. That's GDP. The second one
that would be for the country or the currency, just to clarify, correct?
Yes. So if you were trying to track, for example, if you wanted to look at gold, the big one, the obvious one is the US. So you would look at US GDP stats, and then kind of get that idea. Then the next one
would look at Switzerland as well, just because they have the largest gold holding, or is that completely out of your mind?
Yeah, so we have heat maps for all of the major economies. So we could pull up Switzerland and take a look at this, and we can see, what their economy is like. You can repeat this process for each one. Here's Europe. Here's like I said, the US, you have the UK. You can look at each one of these and study their respective economies and how things are performing for the currency, et cetera. Like this morning, we had PMIs for the UK, which if you saw that on the charts, it moved the UK a bunch because it moved the British pound lower because the data points came in much lower than expected. So we have that data in front of us. We can add that into our understanding of British pound trajectory, et cetera. So again, big 3 are going to be GDP statistics, CPI statistics, and unemployment rate. So if you're looking at the percentage of people unemployed over time, if you're looking at the gross domestic product, the output of an economy over time, and if you're looking at inflation or prices over time, which these 3 things are going to ultimately dictate what the Fed does or the respective central bank, which is the money printer.
And you're specifically saying CPI. CPI, so just anyone watching, CPI is the consumer side, the PPI is the producer side, right? You're specifically looking at CPI, or do you use both?
I use both. The reason I would say consumer price index is so critical is because that's the one the Fed looks at when trying to determine what to do for the American population. They're trying to what are prices for the consumer, not necessarily for up the chain, but for the consumer, what are they looking like?
Yeah. That's really awesome information for anyone getting into, the FA sort of stuff.
Yeah. It's scary at first, right? Like it's so much to learn, but then once you start doing it, the problem is it's really addicting because it's sort of like when you seek the truth and you start finding out information about oh wait, this is the actual mechanisms of why markets move the way they move. The more you learn, the more addicted you get to learning the reality. You're like, oh yeah, this is big boy stuff. This is real world. Why the markets move.
Yeah, you can get a degree from this stuff for sure. I should have listened more in my BCom class.
Me too, man. I didn't take it seriously at that time.
Yeah.
Here's a good question from Regan. When the sentiment overall you're hearing from the public is super bullish on gold, for example, or stock market, but you're seeing, the price action, or in your case, the economic data possibly slowing down. How do you interpret that divergence?
Yeah, so for sentiment's also huge. Sentiment matters quite a bit, and having the right tools again for that is something I also, if we look at, I like using, my favorite way to track sentiment is actually through the options exchange. So we built a connection where you can actually track, this is specifically using GLD options, which is the gold ETF. There's a ton of volume on this thing. And we can actually look at the weight of how many puts versus how many calls are trading day by day. And the reason that's really interesting is I wait for sort of extremes as another, it's another notch in the checklist that I showed you earlier, that big, checkerboard of like bullish and bearish readings for everything. I do look at the put to call ratio, or the software looks at the put to call ratio and says, what are the put to call ratio looking like? So if there's a ton of puts, right, if everyone is out there buying puts on gold or buying puts in the stock market, this chart goes up. And when that gets really extreme, what you'll find is a lot of times those are short-term tops in the market, not perfectly, and that's, again, there's no holy grail, one indicator does all. But it's something to pay attention to when everybody kind of goes short or everybody goes long. I like to use it as a contrarian indicator. So if you get everybody sort of jumping into calls or jumping into puts, that's a huge indicator to what sentiment is like.
So the higher that goes, the more sellers are in the market.
Yes, correct. They're buying puts, they're making bearish bets on the market. And so when that gets extreme, I'll look at that and say, okay, that's more likely, in my opinion, to sort of be a fade that kind of moment rather than, go with it.
Gotcha. Okay, so I seen just last week, I think it was, you took a massive silver profit. Can you walk us through that trade and what was going through your mind?
Yeah. So silver, again, I mentioned earlier just my outlook on metals. I wish I was still in the trade. I got trailed out of it. This is the downside of trailing stops. I took the trade on the 4-hour chart. I caught pretty much all of this move and then got trailed out right around here. So unfortunately, I missed this last leg, but it's perfectly fine. It's going to happen. So I caught a really great trade. Part of the reason I did that was because of the stagflation dynamic that I mentioned earlier, right? So like the theme of metals, in my opinion, is you have, well, not my opinion, but you have central banks buying it aggressively. You have inflation still sticky, a Fed cutting interest rates into sticky inflation because there's problems in the labor market. And this sort of like makes investors look around the room and they're like, where's the safe spot to go? There's, do I want to buy stocks at all-time highs when employment data, to your own concern, is starting to look not super great? Do I want to buy bonds? Do I want to lend money to the US government who's about to cut interest rates with the yields, or with inflation already high? Like, it starts to create this alternative bias, right? Where people are like, okay, I want to do something else. I want to buy something else. So that's where I really like silver. It also popped up on our system. It's no longer a bullish reading. It's since fallen off with some of the growth metrics coming in a little stronger for the dollar. We had unemployment claims and retail sales last week, which bumped the dollar bullishness a little bit. Sure. But at the time, let me see if I can find this. If I go,
the dollar was in recent times has been taking a little bit of a beat.
Yeah. Yeah. And it's, the dollar has been in sort of like this downward trend. So if I look at silver here, what you can see is, I can go back, let's go a little further. So what I'm looking at right now is I'm looking at the historical scores of the Edge Finder for silver. And what this does is it shows me when the Edge Finder kind of started to print some bullishness. And you can see the score topped over a +5, which means most of our metrics started to suggest bullishness for silver around August 8th of 2025. So it held that bullish reading for a suspended period of time. I rode the trend, and then I didn't get out of it because the score dropped. I got out of it because price action reversed, and I used price action to kind of get out of the trades. I just trail stops, as I mentioned earlier. But the bullish rating, or my bias to be long, ultimately comes from what the data is telling me. So at that time, we were getting some really strong confirmations from the Edge Finder. I went long on a pullback and just rode it, trailed it until I got out of the trade.
To confirm, you're using price action with your thesis on what markets could be doing, right? Yes. You're not just blindly being like, I'm thinking the dollar's going to be quite strong, I'm going to start buying the dollar. So I'm going to sell Aussie USD.
Yeah, and if you want to make fun of fundamental analysis, the first thing you can do to make fun of fundamental analysis is you can it's not good at timing, right? Like fundamental analysis by itself, the challenge with it is you can be like, okay, all things point to, I mean, Hunter, you mentioned like some concerns about the stock market. Like I keep coming back to that because that's a great example of like, if you were fundamentally bearish on it and it just keeps going up, you're just fighting this upward trend. So I think both are important, right? Having a technical style for entries and exits, and then having the fundamentals for me helps me to determine the directional bias, the bigger picture. Where are we going? What's the story? And then technicals for red light, green light.
And I think, Nick, also from the perspective of your swing trading, it also, when you are swing trading, it also gives you back more of your time. You don't need to be watching the charts all day, every single day. So you can focus on making content for your YouTube channel or building the A1 Edge Finder, so different aspects as well. Right? That's something that you also focus on too, right? I think a lot of traders, they get into trading, they're like, I'm going to trade full time. It's going to be the only thing that I do. But that's not the correct perspective.
I want to hear that advice too from Nick. Yeah.
And I mean, the funny thing is, like, who am I kidding if I tell you I do not have a full-time day job? This software it's a serious job.
Sure. I can imagine.
So I have a team of people that I'm managing, and like, yes, I trade. Yes, I have reached profitability in my trading, but I have a full-time gig doing, building the tools that we build. And fortunately for me, like, I love it. Like, I actually would prefer that. I don't love it. I just love building these things and creating content around it. So like, I have a day job 100%. And I love that I do. Like, I actually personally don't crave the idea of just trading and that's it. Like, I like having something productive to do that's not just staring at charts.
It's one of the things we really advise the traders is to have some sort of hobby, whether related to trading or completely separate, because trading itself, you'll go insane if you're just looking at the charts all day.
Yeah.
Right.
I agree.
Trying to figure out even from the fundamental side, if you're looking at these two conflicting points of views, you're going to drive yourself crazy.
Yeah, it's so true. Like, it really is. I think it's good to also just have, you can go down the rabbit hole of talking about how important it is to have multiple sources of income, just because, again, it adds a little bit of, like, look, I have ideas all the time that are not right. I have months that are losing months for me. So like, if trading was my only thing, that's like way more stressful than it needs to be, right? Where I can instead have, like, again, I think I'm providing a service to traders who are interested in this sort of stuff, who do want to build these things. I think we offer a tool that is missing in the marketplace. So, I feel some fulfillment from doing that. Like, I feel like it's really cool to connect with other traders who like what I like. And, we have like free courses all over our website. Like, we don't sell any education, but we do sell software, and we sell it aggressively.
Yeah. It's a really admirable way to do it. This is awesome software too.
Thank you.
I think I need to watch more of your stuff on this. Actually, it's been a long time.
The disclaimer is that it's if you start going down the macro fundamentals, you are going to be that guy at the party who just wants to talk about the jobs market all day long.
Yeah, I actively do not talk about my job when people ask me at a party. I just say stocks or something. I'm a crypto bro.
Yeah.
And then they're like, help me invest. I'm like, I don't know how.
Right. Yeah, exactly.
Yeah. So we have another interesting question here. How do you let the macro events such as like elections and wars that are basically, I'm saying, non-red folder events influence your trading?
Yeah, that's actually a great question. I think that when it comes to geopolitical events, I actually tend to put that as a backseat item to the hard data. So what I mean by that is, if you're somebody who's chasing news headlines, that's another reason why people really don't like fundamentals, is because their perception of it is, so you're reading the front page of CNBC every morning and you're just freaking out about what you're seeing.
Following Jim Cramer.
Yeah, right. And that's not what I do at all. Like, I look at the actual data that's rolling in. I don't really look at like news headlines very much. Again, like, if the Trump tariff stuff's caused huge market volatility, but I actually I did really well in that period because I did not look at the headlines. I looked at the data, and the economy was not breaking down despite there was terrifying stuff. There were all these projections for how it was going to break down in the future, but meanwhile, corporate earnings still really strong. There was some other hard data. There's like soft data, which is like expectations of the future and predictions and news articles. And then there's actual hard data, which is the actual GDP stats, the actual inflation. And I look much more at the hard data, like what's actually coming in.
Yeah, that's a great answer, because you can so easily be swayed by, hey, there's a war now, market's going to go down, and then next month there's an election, market's going to go down. Yeah. Kramer yells something, market's going to go down. Oh, housing market struggle. There's always this fear, and that's the problem with the media, is they're incentivized to cause fear and panic, because that's what clicks, right? So you're always going to think it's not the right time to be investing.
Yeah. Well, and there's so much like self-destructive bias that goes into it. I'll give you a quick example. I'm not a huge, fan of like making huge political commentary or getting super invested in terms of my time and that sort of stuff. But a lot of traders completely abandon their strategies and abandon ship during that time on both sides. So I'll give you an example. Before the sell-off that we saw in March and April, a lot of people overly touted that, Trump's in office, the world's going to be perfect, it's going to be great. And they FOMO bought into stocks right before stocks had a massive correction in a very short succession. Then things turned around, or they dropped heavily, and the reverse happened, where a lot of people who disliked Trump sold the market because they were like, hey, he's going to tank our economy, the world's going to end, and it's going to be terrible. So they sold their stocks. The point that I'm trying to make is that if you let that political bias or your emotional bias about markets get in the way, it can be destructive, because both of those people lost. If you made huge bets at the top of the market because you love Trump, or you made huge bets at the bottom of the market because you hate Trump, both of those things cost you huge. So I'm a big advocate of the hard data, because it doesn't leave all that political bias in there.
You could have a really awesome setup to do the opposite of the news events when paired with the hard data. And
Agreed.
You could have a pretty interesting trading strategy that way. It's just look for those panic sells in the data telling us the opposite.
So that's actually, Hunter, the thing is, that's part of the Edge Finder's function, because I'll tell you what happened in April, right? Stocks are dropping like crazy. What did the put to call ratio do? It skyrocketed. Yeah. So sentiment was terrified. Everyone was petrified of the market. Meanwhile, the hard data looked good. What does that produce? Bullish readings. So we got bullish readings because it was a contrarian, put to call ratio plus economic data that was holding up. The system told me to go long. I went long as anything.
James, do you see how excited he just got there?
I love it. Throw an easy one for me.
Awesome.
No, and I guess last thing to say about that is that it is easier to talk about your wins. Obviously, there are many times where, like, sometimes you're wrong, not only necessarily like in direction, but sometimes you're wrong in the timing. Like sometimes the data looks good and my setup looks good, but I take losses. Like losing streaks still happen. Fundamentals don't cure that. Nothing is perfect. So I don't want to come across as like 2025 has been a really good year for me. 2024 was a good year, but I underperformed the market. 2023 was a really good year. 2022 was a really tough year for me. I had a really big drawdown in 2022. So by no means am I saying what I know is just the best and it's all easy money over here, but rather that building this data set has really opened my eyes to the way markets move, and building a system that I'm comfortable with the losing streaks and winning streaks it produces.
I got two more questions for you, and James might have some more, and then we'll wrap up.
Okay.
If you were to start from zero, I like to ask a couple just simple ballpark questions at the end. If you were to start from zero, what would be the steps you would do in order to, boot up your trading career?
If I was to start from zero and I also didn't have any sort of nobody knew who I was in the trading space, because if I had to start from zero, I would probably try and get a job at like a brokerage doing content or something. But if I didn't have any reputation, nothing, and I was just getting into trading, how I would start is probably the least social media fun answer, which is I would actually lean into my day job and I would get as good as I could and find promotional opportunities within my job to build as much capital as soon as I possibly could. I don't have a ton of experience personally trading with prop firms, But they also weren't really a big thing when I was getting into trading. So I probably would explore them. If I was back to square one, I'd probably explore what it means to get funded, how to approach that. Like I'm at a point in my trading now where I don't personally need to get funded. And I know, Hunter, you've talked about this in the past, like the concept of like taking it and converting it to a small personal account if you want to. That's an option, right? So I think I would work towards that. I would just embrace the slow and steady, right? It's what I've done now. It's what I would always do if I were to start over. I have no, sorry, my computer just shut off for a second. Yeah. So anyways, I would embrace the slow and steady.
Yeah. Awesome. And then the last question I have for you is the one key takeaway that you've learned over your decade of experience that made you a better trader that traders can walk away with today.
So nobody does it except for the pros. Back test your systems, because everybody thinks they have an edge, but they may not. And you don't know you have an edge or not until you actually do some demo testing on a demo account or a small live account, or you go into a back testing environment and really put your skills to the test and give a hard look at what your results are if you took 1,000 hypothetical trades in a demo trading or back testing environment. I say that because everyone sort of like thinks they've got a trading system that's going to work great for them, or they heard someone talk about it. Even my own system, I could show you exactly how I trade. It's not 100% rules based, but even if it was, you can still mess it up if you don't have the experience with it, if you don't know how to spot. We all see the markets a little bit differently. So back testing is so important. And again, my background in software engineering led me down a path of back testing everything. And it changed everything for me in my trading, because I actually started to see, okay, this system, what's the Sharpe ratio on it? What's the average risk to reward? What's the win percentage of it? What's all of these things that really matter. And most traders just sort of ignore because it's a lot of work.
Before we head off as well, so this is something that you said, and I actually took a screenshot of this, Nick, because a lot of people, so I've got a degree. I think you do have a degree as well, Nick. And I think sometimes, Hunter, I don't know if you got a degree, dumb money Hunter.
I do.
Got one as well. So I think for the people, so for all three of us, we understand what it takes to finish something we start in terms of a degree. And I think you gave a great answer. Someone asked you, and a lot of people also ask me, family, friends, stuff like that, what does it take to trade full time? And this was your answer. My honest answer is that learning to trade profitably is about the same difficulty as getting a 4-year engineering degree. It's not easy, and I would discourage anyone from doing it unless you have a very considerable passion for financial markets and economics. And I think that was about 3 years ago. And a lot of people ask me, what does it take? And I send them that actual screenshot. And I think a lot of people, traders listening here, just think that it's easy and they're just going to get into it because they see these, as you said, guys online that portray this unrealistic expectations. And I think the more you can actually get to grip in terms of like, this is a career, like becoming a doctor or lawyer, dentist, whatever it is, the better that you give yourself a chance because you're thinking long term.
Well said. I mean, I think the long story short for me is people tend to go further in things they actually care about. If you don't actually care about trading, you just want to make money, you're better off doing something else. There are better ways to make money in the short term than trading. In the long term, I think trading is a remarkable way to scale wealth and become very wealthy with a lot of time. But if you don't enjoy the process, you're not going to go nearly as hard as the person who, is all in because they absolutely love it and they love learning about markets. Same thing with any degree, right? The people in any industry or study or field of work, the people who are at the top usually really love it and they're obsessive with it.
Yeah, totally. Did you also find it ironic when you said well said when he was quoting you?
Yeah.
Guys, that's the podcast. Thanks, Trader Nick, joining us once again. I'm sure everyone loved you. Just branch out where they can find you.
Yeah, just search me up on YouTube, Trader Nick, or if you want to explore our stuff, just go to a1trading.com.
Awesome. Thanks, guys. We do this every single Tuesday. The winner of the $50,000 Maven Challenge is going to be posted in the Discord, Maven, discord.gg/Maven. See you, Nick.
Cool.
Thanks, James.
See you guys. Thanks for having me on.